Before we talk about liquidity, price imbalance, order blocks, and how to put everything together, let's first look at premium and discount price zones and how important these zones are in increasing the probability of a winning trade. Just like the name implies, premium price zones are zones in the market where financial institutions find the price high enough to take their sales. And on the other hand, discount price zones are the zones in the market that they find the price is discounted enough to take their buys. So this means that when the order flow is bullish, then our focus is mainly going to be on discounted zones. And in a bearish order flow, we focus more on the premium price zones. So I'm going to use a line drawing so that I can illustrate to you the theory behind these zones before we go to the chart. Now let's first look at a bearish order flow where we are breaking structures downwards. So if we identify the swing highs, then you can see that we have a swing high there, swing low, swing high, swing low, and we are breaking structures downwards, meaning that the order flow is bearish. I'll just make this a solid line for clarity. So what we expect is price to retrace up to a supply zone within this range of the market before we have a reversal and eventually break of structure downwards. So normally price will retrace back into a premium price area, and that premium price area could be somewhere around here. But the area could also be around here. So you might find a case where you have multiple supply zones. So you find there's a zone there, there's another zone around this area, and you find we also have another zone around this area. So looking at this range of the market, so if we want to take our trade within this range, then it simply means that we are going to identify an area within this range where the price is premium. So to identify the premium price area, we use Fibonacci retracement tool. Now I'm going to show you how to set up your Fibonacci retracement tool, but I've already set mine, so I'm going to use it to illustrate this for you. If we put a Fibonacci tool from the upswing to the downswing, then you realize that within this zone of the market, the price is premium, while here the price is discounted. So any zone that is above 75% is a premium price zone, and below 25% is a discounted price zone. But technically, whenever price retraces beyond 50%, then we still consider that as premium price zone. So that means that price can respond to this zone here or this one, but not this, because this is below 50%. Now let's look at a case where the market is bullish. So similarly, we have a bullish order flow, and we expect a retracement of price back to a discounted zone, breaking structures upwards, meaning that the order flow is bullish. We expect a price to retrace into a discounted price zone before the financial institutions and the banks place their orders. Now let's look at a case where we are having multiple demand zones. So we have a zone there, another one around here, and another zone around this area. Now if we take our Fib tool and put it from the top to the swing low, then we can see that this zone is discounted price zone. Anywhere below 50% is also discounted price zone, but any price zone above, the price zone above is premium price zone. Now when we are looking to take a buy, we want to buy from a discounted price zone. You only buy when the price is lowest. Therefore we expect a retracement into this zone here and a sell-off, or into that zone and a sell-off. Now before we look at this on the price chart, these are the Fib settings that you need to take note of. Normally the default settings for the Fibonacci is a little bit messy, so it looks something like this. And you can see that we have so many levels of price, so many levels of retracement. So to change this, first of all, untick everything else, and after that, just tick 0, 1, and 23.26, change it to 25, and 78.6, change it to 75. Then you can change the label from values to percentage. So we have 100% retracement, 75% retracement, 25% retracement, and this is 0% price area. Now let's add in the 50% price retracement. 50%, yeah. So you can change the colors to suit how you want it to look, but this looks a little bit simple and easy to understand. So this is the discounted price zone, and this is the premium price zone. So now let's go to the charts. So the first step is to identify the swing highs and swing lows. So we have a swing low here, swing high, swing low, swing high, low, high, low, high, low, and we have a final high there. This is a bullish order flow. So looking at this zone between this point and that point, we put our fib tool, we mark it from the swing high to the swing low, and we expect price to retrace back into the discounted price area. So you can see there's a retracement of price into the discounted area, and price has sold off upon reaching 50% of price retracement. Similarly, we have a sell-off and another retracement. We can see that we are having a demand zone here, and we also have another demand zone down here. And there's another demand zone at this area of the market. So looking at these three demand zones and using our fib tool from the top of the range to the bottom, we can see that this demand zone here is within the premium price zone, just at the border 50%. So this can still apply, but we can see that price has reacted to the demand zone that is at the discounted price area. Similarly, we have another retracement. We have a price range from this point, between this point and that point. And if we use our fib tool, then we can see that price has responded to this demand zone here, which is also at the discounted price zone. And then we have a sell-off. And similarly for a bearish order flow. So we have a swing high here, a swing low, swing high, swing low, swing high, and probably another swing low down there. So let's focus on this range. Let's focus on this range here. And if we use our fib tool, then we can see that price has retraced above 50%. Similarly for this range here, we have price retracing into the premium price zone, responding to the supply zone, and eventually selling off. So that is how we apply premium and discount price to increase the probability of winning a trade. So I'm going to replay the market and see how to apply this tool. So we have a bearish order flow. There's a swing high there, swing low, swing high, swing low, swing high, and another swing low. So we have a break of structure down here. So we have a break of structure, and this break of structure has originated from this zone here. So that's the origin zone. We have another zone here. We have another supply zone there. And finally, we have a decision zone down here. So this is the zone that has broken structure. Now, if we apply the fib tool from the top to the bottom, from the swing high to the swing low, you can see that we have a premium price zone here. This is also falling within the premium price zone. Trades that are taken from this zone and this zone would give us high probability of winning. Therefore, we have price retrace into that zone and breaks it within just a single candlestick move. So we can remove that. Then we have price tap into that zone. So as soon as price taps into this zone, we can go down to 15 minutes so that we can look for an entry. Now on a 15 minutes, what we are looking for is a break of structure. So we want to see a break of structure downwards to confirm that there's already a reversal and alignment to the order flow. Remember, the order flow is bearish, so we also expect the retracement. We also expect internal structure to change from bullish to bearish. So we have that happens. We've already broken structure here. Now when the market has started to retrace back, we can put our fib tool from the swing high to the swing low and identify the premium price area. So we have an order block. We have an order block here. This wick is above this buy candle and this candle. That makes it a valid order block. And we also have another order block here, meaning that we can sell from either this order block or this one here. But if we look, this is falling right within the premium area. This is also at the premium area because it's above 50%. Now, we can take our trade from here, just put our stop loss above, and we can also have another setup at this point here. So if we get out of the market at the swing low, so our swing low is down here. So if we go to a 4-hour time frame, then we'll be able to identify the swing low of the market, which is down there. So there's where we expect to take our profit. So back to 15 minutes. Both the two setups are within premium price zone, but this zone is more premium than that one. Now, based on where the market turns, we'll be able to make a decision which zone to go for in a case where we have two zones to make a decision. So if we play the market, so we'll go to 4 hours so that we can be able to see clearly how our orders are going to be filled up. You can see that price has reacted to the zone above and not the one that is below. And then we have a sell-off all the way to take profit. So that is how we use the discount and premium price zones to increase the probability of our wins. See you in the next lesson.